Well, the key to markets right now is the outlook for interest rates, and that means the outlook for inflation. It's been the big talk since our budget was released Tuesday night, and no doubt will be part of Peter Dutton's budget in reply speech this evening. Today, we got more clues from the US, where the headline inflation rate there fell to 4.9%. Meanwhile, China's April inflation was the slowest in 2 years, 0.1%, down from 0.7% last month. Earlier, I spoke with Kenny Polcari from Kace Capital in Florida. He's a regular commentator on Fox Business, CNN and CNBC, and I asked him whether this is all good news, seeing as the Federal Reserve's now got its cash rate higher than that headline inflation rate.
It's a very interesting conversation, and which is why the market struggled today, because there's really two numbers you look at on the CPI. You look at the top line rate, and then you look at it ex food and energy, right? And so ex food and energy, the number was still 5.5%, which is still high. If you look at the top line rate, it came in at 4.9%. So it appears as if, we're going lower. And we are going lower for sure. I'm not arguing that. I just would argue that, which one is the more important number and where is, in fact, the terminal rate? Are we at the inflation rate? Are we still a little bit below it? Or are we now getting a little bit above it? Because in the end, the Fed needs to have the terminal rate above the inflation rate in order to tamp it down. And then, like you said, probably enter now an on full recession if they finally come out and declare it, which they haven't done yet. But I think it's only a matter of weeks before they have to do that.
Because it's going to be interesting to see what the Fed does, because here in Australia, when rates were paused, what you got was a sudden boom in housing sales. You suddenly had the economy tick up, almost in anticipation that there are no more rate rises. We've stopped banging our head against the wall. I just wonder whether that is the situation in America, because, of course, this inflation rate is not back at the 2 to 3% mark where they'd like it to be.
No, it's not. It's going to be a long time before it actually gets to 2%. What this really tells you is that, prices are still rising by, let's call it 4.9% or 5%. So it's not that inflation is completely subdued. It's not. While it's rising at a slower pace than it did a year ago or last month or 2 months ago, their prices are still rising at 4.9%, which is well above that 2% rate that they talk about. So I honestly think that the next move for the Fed in June is going to be one more rate hike, because one more is going to get us to 5.25, 5.5, which will absolutely put us just at or slightly above inflation. And I think that's where they want to be. I think the Fed has made that clear. That's where they want to be. I think they've been very clear about that. A range of Fed speakers have been pointing towards that higher number all along. And I think one more hike in June is going to get us there. And then I think they're going to pause. I think this idea that the market is already pricing in 3 25 basis point cuts by the end of the year is mind-boggling to me, because I'm not really sure why or where they think that's going to happen. Large asset managers across the country are not in that camp at all. They think that the Fed is going to raise and then pause it and hold it there through the end of the year and give it time to permeate through the economy to see where, in fact, we go and how deep of a recession we go into.
Well, that's the point about the recession, because it's often that last rate rise, like the last straw in a camel's back, that breaks the camel's back. In this case, actually plunges the economy into recession.
Well, you're right. And so now what's going to happen, don't forget, though, last Friday, we got a very strong non-farm payroll report, right, in terms of job creation, stronger than they expected, and wages continue to have upward pressure on them, not what the Fed wants to see. And on top of that, the unemployment rate ticked down versus up, going from 3.5 to 3.4%, which continues to tell you that the labor market is strong. And that's an issue for the Fed at this point, right? Because they want to see that back off a little bit. Economists and analysts here will tell you that the unemployment rate has to have a 5 handle on it in order for the Fed to ultimately be successful. We're at 3.4, so we're 1.6 percentage points away from having a 5 handle. And Larry Summers, the former Treasury Secretary, said the number has to have a 6 handle on it. So I still think there's room to go. It doesn't necessarily mean that the Fed's going to have to keep raising. I think they could raise one more time and then hold it there and allow that to work its way through the system. Look, in addition, we've also got some rumblings in the commercial real estate market, and that's causing lending to be pulled back by a lot of the banks, both regional and the money center banks, and that as well is going to help do some of the work for the Fed. So while I think we're closer to the end in terms of rate hikes by the Fed, I don't think it's over yet.
Yeah, well, you think about it, you've got the debt ceiling issue, which is coming to a crescendo fairly shortly. You've got the collapse of these regional banks, which raises questions about the amount of liquidity in the system. And then, as you say, you've got these employment numbers which are out there, which are all slightly conflicting situations for the economy.
That's right. Now, listen, the debt ceiling, while it's all very dramatic and both sides are creating all the histrionics around it, and they're using very dramatic words like disaster and tragedy and catastrophe, words that will just get everybody anxious and get the markets anxious. In the end, the U.S. is not defaulting on its debt. You know that. I know that. They're going to push it till the 11th hour. Could you get a government shutdown? Absolutely. But guess what? Anyone that gets furloughed is going to get paid when they get back, which is really stupid. Just leave everything open, continue to pay them. Why are you going to send them home to create all the drama, bring them back, and then just give them all the back pay? Stop the histrionics and just get through with it. And in the end, I think that's what we're going to see, right? We'll see this positioning back and forth. Remember, both sides have to show it as a win. Joe Biden, has to show that he didn't give anything and that he won, right? And that he got a clean debt ceiling. While Kevin McCarthy, on the other hand, has to show his caucus that, he extracted something from the administration. Otherwise, his own caucus won't support him. And the problem with that is that the Democrats know that. They know that Kevin McCarthy is walking on a very, very, very thin string. And if he doesn't get what the caucus wants, there's a good chance that they'll throw him out. And so the Democrats and the president can afford to push this right till the end, until the 11th hour, which is exactly what I think is going to happen.
Sarah, Kenny Polcari, it's always great to chat to you, get your insights. We'll do it again shortly. Many thanks for your time.